Pioneering Portfolio Management, an Unconventional Approach to Institutional Investment, fully revised and updated by David F. Swenson. From the mid-20th century to today, the Yale Endowment has achieved tremendous success. But how did they apply the right investment principles to make the correct investment decisions? The former Morgan Stanley Investment Management chairman Barton Biggs once said, "There are only two great investors, Warren Buffett and Julian Robertson." Julian Robertson is the author of this book and the chief investment officer at Yale University. Robertson is recognized as a critical figure in institutional investing. He led Yale University's Endowment Fund to remarkable success and contributed to education as he taught at Yale. In 2009, he was invited to serve as a President's Economic Recovery Advisory Board member under President Obama. This book shares the success of the Yale Endowment Fund under the leadership of David Swenson. It tells us why the fund is successful and provides readers with valuable insights. The book is structured as follows. 1. The success of the Yale Endowment Fund. 2. The portfolio management tools used by the Yale Endowment Fund. 3. The investment decision-making process at the Yale Endowment Fund. Let's look at the first key point, the success of the Yale Endowment. First, let me introduce the Yale Endowment. The Yale Endowment is Yale University's investment fund. Yale University is one of the 8 Ivy League schools in the United States and is the third oldest university in American history. It consistently ranks among the top 10 universities globally. Among its alumni, Yale has produced 5 U.S. presidents and 19 Supreme Court justices, and its faculty, researchers, and alumni have received 60 Nobel Prizes. The Yale Endowment provides financial support for Yale University's operations and development. In 2009, the endowment contributed 45% of the university's budget. The Yale Endowment Fund is renowned for being one of the world's most successful and profitable endowments. Over the past 30 years, it has achieved an average annual investment return of 12.9%, resulting in investment gains of $26.6 billion. This success is even more remarkable because the Yale Endowment has maintained a stable investment performance over the years, with few significant fluctuations. The key to their success lies in their investment strategy, summarized in 2 words: risk management. The Yale Endowment consistently emphasizes risk management as a core principle. This approach ensures that when the stock market is in a bear market phase, the endowment stands out, performing exceptionally well. It is because when you lose 20% in the stock market, you must earn 25% to compensate for the loss. If you lose 50%, you must make 100% to recover the initial investment, which aligns with Warren Buffett's 3 investment rules. Rule No. 1. Never lose money. Rule No. 2. Never forget Rule No. 1. Hence, avoiding major investment mishaps and achieving stable annual profits is considered a victory in the market. Over the long term, the Yale Endowment has proven to be a resilient player in the market. The Yale Endowment employs a strategy that includes stress testing. This involves examining all expected returns through various nightmarish scenarios. They convene an investment committee once a year to scrutinize and debate all aspects of their investment portfolio. This commitment to testing and retesting conclusions has become a tradition. They consistently refer to historical experiences when selecting fund managers and asset allocations. The goal is to identify potential risks and challenges before they occur. In summary, the success of the Yale Endowment Fund can be attributed to 6 key factors. 1. The endowment's consistent risk management strategy is based on defense. 2. An objective, friendly investment culture at Yale Endowment, fostering mutual respect among staff and a sense of responsibility among investors. 3. Talented fund managers who thrive in a friendly investment culture. 4. The endowment's commitment to Yale University's long-term well-being and development. 5. An extensive network of influential contacts. Yale alumni include 5 U.S. presidents, 19 Supreme Court justices, and numerous Nobel laureates. Yale Endowment alums' extensive and influential network continuously provides valuable insights and information, another key to their success. 6. The nurturing of many notable fund managers benefits not only the endowment but also the broader financial industry. Let's continue with the second key point: Yale Endowment's investment portfolio management tools. Leo Tolstoy had a famous saying, "All happy families are alike, each unhappy family is unhappy in its way." Applied to the financial market, successful investors are often alike, while failed investors each have their unique reasons for failure. Whether it's investment giants like David Swensen, who manages institutional investments, value investors like Warren Buffett, or famous international traders like George Soros, successful investors all share a common trait: they follow a consistent investment philosophy and apply it throughout the investment management process. In investment portfolio management, there are 4 primary tools: asset allocation, diversification, market timing, and security selection. Let's explore them further. 1. Asset allocation. Asset allocation is a fundamental step in any investment strategy. It is widely recognized in financial markets that sound asset allocation decisions play a significant role in determining investment returns. The effectiveness of market timing and security selection is secondary. Asset allocation involves selecting and defining various asset classes to construct an investment portfolio. It determines the allocation of different asset classes in the portfolio, such as stocks, bonds, cash, and commodities like precious metals and currencies. This approach is about setting your stock-to-bond preferences along with diversified investments. If we look at the historical perspective, the U.S. stock market has experienced long-term bull markets. Even though there were significant economic downturns after World War II, the U.S. stock market still saw a gain of over 60 times its value. The U.S. stock market is the most mature stock trading market globally, and it genuinely reflects economic conditions. Hence, stock markets have been preferred over bonds. In fact, the preference for stocks is driven by their potential for substantial long-term gains. $1 invested in U.S. short-term government bonds in 1925 would have grown 18 times by 2005 due to compound interest. However, inflation significantly eroded the purchasing power of that $18 over 80 years. In contrast, $1 invested in U.S. long-term government bonds in 1925 would have grown 71 times, representing a real increase in wealth over time. $1 invested in U.S. common stocks in 1925 would have grown 2,658 times. It implies that the initial dollar had transformed into $2,658 by the end of the 80 years. Therefore, the preference for stock equity investment is rooted in historical performance. 2. Diversification. Another key concept in asset allocation is diversification. The saying, "Don't put all your eggs in one basket," applies perfectly to financial investments. In the stock market, diversification reduces risk without compromising expected returns. A well-diversified portfolio should hold different asset classes and different individual securities within each class. This minimizes the exposure to any one specific asset or security, reducing risk. 3. Market timing. Market timing involves deciding when to enter or exit various markets or asset classes. For example, if the stock market is experiencing a bubble, a fund manager can reduce stock holdings and allocate more to bonds. Conversely, a fund manager can reduce bond holdings and give more to stocks if the stock market is significantly undervalued compared to its actual value. For security selection, this step involves choosing specific securities within asset classes, like selecting the S&P 500 index or the Nasdaq index. It also includes choosing between short-term or long-term U.S. government bonds, depending on the investment strategy. In summary, asset allocation, diversification, and strategic security selection are the primary tools used in investment portfolio management. Successful investors consistently apply these tools, and they play a significant role in determining investment returns while managing risk. Let's review the final key point: Yale Endowment's investment decision-making process. During its annual meetings, Yale Endowment decides on asset allocation decisions that significantly impact investment returns for the year. These policy decisions are essential because they help avoid making erroneous choices due to market exuberance or downturns. Why are policy decisions discussed? They are crucial because they can prevent making decisions based on market consensus or following other investment institutions, which can lead to costly mistakes. In the past, Yale Endowment learned this the hard way. In October 1987, after several years of a bull market, the U.S. stock market experienced a sudden crash. Many institutional funds lost billions of dollars overnight. In late 1987 or early 1988, Yale Endowment convened special meetings to discuss whether they should reduce stock holdings and increase bond holdings in response to the market crash. The meetings resulted in the decision to increase stock holdings and decrease bond holdings during the market's downturn. In hindsight, this decision was right, demonstrating the importance of such policy decisions. In addition to discussing policy decisions, addressing the various challenges faced in investment decision-making is essential. These challenges can be categorized into 3 types. 1. Short-term thinking. Short-term thinking refers to focusing on immediate gains rather than pursuing long-term victories. A short-term investment approach has lower success rates and carries higher risks. Investors with a short-term mindset often need help finding opportunities in this pursuit of quick profits. Long-term investors, on the other hand, face significantly lower risks and can draw many lessons, such as not engaging in frequent trading, which can lead to costly transaction fees and losses. 2. Consensus-based investment behavior. Human psychology often leads to consensus-based investment behavior. There's a well-known psychological experiment by a psychologist named Ash. In this experiment, a group of people is shown 2 identical pieces of string, and all but one person is in the experiment. The group falsely claims that one string is longer than the other. When the one person not in on the experiment sees this, but often succumbs to peer pressure and agrees with the group's false assertion. This experiment illustrates the human tendency to conform to consensus. In investment markets, the majority often follows a particular belief, even when flawed. Additionally, institutional fund managers tend to play it safe. If they succeed with a traditional investment strategy, they will likely retain their jobs if they experiment with unorthodox methods. Therefore, there is an inclination to stick to familiar and seemingly safer strategies even when they may not be the most optimal. 3. Contrarian investment. Contrarian investment requires investors to have unique abilities and the willingness to swim against the tide. Contrarian investors do not follow the crowd but make independent decisions. It's crucial to analyze a company's fundamentals diligently and ensure that the reasoning behind buying or selling is clear. Contrarian investing can yield success, as many successful investment cases originate from this approach. However, it takes work, as it requires a departure from the crowd and an ability to make decisions that may appear unconventional.